I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them.
They knew what they needed to do, and I think they've proven that they're willing to respond quickly.
We see pretty much every half day another measure being put in place. So we do think that over the coming days that things will calm down.
In actuality, this rise of uncertainty has been in place for about 5-6 years. If you're not concerned, you're not paying attention in this kind of marketplace.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. A tumultuous week draws to a close. The market welcomes a $30 billion rescue deal for First Republic Bank, but Bill Ackman isn't impressed with the move. The ECB delivered a rate hike. Now all eyes are on the Fed's meeting next week, with traders debating whether the central bank will follow suit. Meanwhile, in Switzerland, there are rumblings of a combination of Credit Suisse and UBS. Our reporting suggests both banks are pushing back. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, what an incredible week it's been. A little bit of confidence returning to markets, it seems, this morning. Well, yesterday and this morning.
2 weeks, actually. It just dawned on me that my COVID experience is much like the banking crisis. You know, it hit hard at first, and it was a surprise. I came back after emergency measures rescued me, but then an old case came back to haunt me, and I needed the SNB to step in. In any case, what we're looking at right now is another gain in futures. After the resurgence that we had in equities yesterday, we're almost back to 4,000 on the cash trade, and it looks like we could get there at the open this morning as well if we continue this positive move. The U.S. 10-year yield coming down 1.5 basis points, but back down at 356 right now. Of course, we, over the past couple of weeks, have been up 50 basis points and then back down. We do see a big jump in gold. One of the things that we've noticed is, or that I've noticed, is you haven't seen a huge run to the perceived safety of the U.S. dollar. You didn't see us going back up to new highs on the Bloomberg Dollar Index or the Dixie. That really hovered around its usual levels. But you have seen investors reach to safe havens like gold, or, dare I say it, without being flamed on social media, like Bitcoin. 26,000 and change after the banking, I think we can use the word crisis, that's happened over the past couple of weeks, has only driven Bitcoin higher, which is fascinating. Take a look at what's going on in Asia. They had big gains there overnight on the MSCI Asia Pacific, up 1.33%. After the multiple bailouts that we had. I mean, you name it, right? FDIC, Federal Reserve, SNB, and now all the big banks on Wall Street. That's driven the Hang Seng up as well, 1 2/3%. You've got the Nikkei that closed up 1.2% higher. And the dollar is weaker against the yen right now. You can only buy 133 yen for the dollar. That hasn't really moved much at all during these past couple of weeks of crisis. Take a look also at some of the headlines that we're getting across right now, and China cutting the triple R, and that could boost assets even further.
Yeah, absolutely. This equivalent to sort of putting in more money into the system, essentially. So not requiring banks to keep so much in reserve. So seen as equivalent to sort of monetary stimulus. China cutting its reserve requirement ratio, triple R, the amount that banks have to keep in reserve and can't lend out, cutting that by 25 basis points. So a quarter of 1%. So really interesting to see the central bank there in China. Concerned enough, perhaps, what about their own economy or the global story, that's what they're doing at this point. It's an interesting development. We will no doubt dip into that story later on in the programme as well. European equity markets, even before that news, were pretty positive. The map was all pretty green, even if we were off our earlier highs, given the news flow around First Republic and some of the, a little bit of calmness returning to the banking sector. The energy stocks doing really well. We are down by 10% on oil prices month to date. So that's an interesting one to watch in terms of the Chinese development story, of course. And so energy stocks not focused on that, focused on the rebound in oil prices that we're seeing this morning. This is recovery in the banking banking sector. We saw some of this yesterday, a little bit more of it today. We are off highs, though. This was higher around half an hour ago, but we're up by around 1.6% on the banking sector. Here's one of the banks, doesn't sit within that sector, actually sits within financial services, but it is another bank in focus, of course, the bank in focus here in Europe. And the stock is down now by 3.6% after actually starting in the green this morning. And I just put in the euro, 106.57, as we see equity markets showing strength, and so money coming out of the dollar, and room for the euro and the pound to rally this morning. Then, Matt.
If an extra 50 billion francs won't help you, what will, right? Well, here stateside, the biggest banks on Wall Street have agreed to deposit $30 billion with First Republic in an effort to stem the turmoil that sent depositors from that bank fleeing. Sonali Basak, our global finance correspondent, joins us now with details on the latest bank rescue package. Sonali?
Listen, this is certainly a historic package. You think back to the panic of 1907 when the last time the banks got together,
I often think back to the panic of 1907.
Do you
Yes,
really?
of course.
You have a strange mind. But anyways, remember, if it was just that, it would be one thing. And remember, this is a really quite historic package here. They say it started with the 3 J's, as the Financial Times puts it, or as our own Hannah Levitt puts it, it's the panic of now 2023. This started with a call earlier this week with JP Morgan CEO Jamie Dimon, as well as Janet Yellen of the Treasury Secretary, as well as Jerome Powell. And the idea here is that confidence put in by the big banks would start to stave some of the issues, certainly in First Republic, keeps the door open for a sale. Remember, once the situation gets more difficult, a sale also becomes more difficult. It's interesting to see how the other banks also reacted in the wake of this rescue package. The form of deposits is interesting because it's not wiping out any equity. It's not diluting anybody here in terms of the shareholder base. You saw Western Alliance spiking on the back of this news. You saw PacWest not get the same amount of love in the stock market on the heels of this. Remember, the bigger issue here is not just First Republic, but any potential fallout and spread across the financial system. You know, if you think back, some people have drawn, Anna, the parallel to the savings and loan crisis. Many more banks failed. We saw 3 in a week, and then this big rescue in the United States. But the scale and the speed at which all of this happened is certainly unprecedented to most of the people who were involved in a lot of these
Just
crises.
like Matt, I do think back to 2007 fairly often. We'll leave 1907 to the historians, though, Sonali. But let me ask you about how this is all being received by investors, what they're doing with First Republic in particular, because you see there the pre-market trade. After hours, this was actually a stock that weakened quite a lot, as if maybe the market not sure about some of the details here, and other voices are concerned about what this means for the rest of the banking sector. Bill Ackman, for example, is worried about contagion from this into other banks.
There's been the worry about contagion, certainly, and I think the other issue that's underpinning what Bill Ackman had to say is that every time, Anna, one of these rescues happen, the question from the market comes, is it enough? When the next issue happens, how is that bank saved? You've seen a number of measures, extraordinary measures, really be taken by the Federal Reserve already, and now the banking system itself. What happens to the next bank? I think, interestingly, in addition to the stock price movements of all of these firms, is this idea here that a record amount of money was used to borrow from the discount window from the Fed, and the 2 facilities set up by the Federal Reserve in this latest crisis has already been tapped at a significant scale. It's hard to tell where this is going. The government and the other banks are telling you they'll do what it takes. That's really what all of this comes down to, is the messaging. But what happens next time, and then the next time, and then the next time? That's the question.
All right, Sonali, thanks very much. Sonali Basak there talking to us about the latest, this time private, bank rescue package put together. Now, all banks in the U.S. have borrowed a combined $165 billion from 2 Fed backstop facilities in the past week. It's a sign of escalated funding strains in the aftermath of Silicon Valley Bank's failure, to say the very least. Kriti Gupta, our markets correspondent, joins us now with more. Kriti?
Yeah, there's a lot to digest here, specifically that $153 billion that a lot of these funds are accessing for their discount window. For the record, this is not the funding program that we saw kind of kicking in over the weekend. And this is really important when we talk about it from a macro perspective, because at the end of the day, it is now being viewed as stimulative, some sort of form of quantitative easing. We'll get to that in a moment. But remember, $153 billion, nothing to scoff at there. And like I said, this is in addition to the Bank Term Funding Program that the FDIC and the FedStop used to backstop this past weekend of $11 billion. On top of that, just the cherry on top of a pretty bad Sunday, is the loans to the FDIC, $142 billion there. And as a kind of combination, this is really important because it's not just that 153 that's seen as easing. The discount window historically has been seen as something to kind of frown at, a little bit of a stigma. It looks like that stigma perhaps coming off just a little bit.
OK, and let's move on to what all of that means for the Fed next week then, Chrissy. We, of course, look ahead to the Fed's decision, and there's a wide range of expectations out there on Wall Street as to what the Fed might do. You wonder if they are having some of the same conversations, some of the same thinking as we saw at the ECB is going on at the Fed.
I think they absolutely are. And I think one of the core questions is not necessarily about the rate hike that you're potentially going to see. Remember, the market is now priced for about 25 basis points, but Wall Street kind of calls range from 50 basis points to a 25 basis point cut. So really seeing a broad increase. But I got to say the highlight call has to be from Nomura, the idea that it's not just a 25 basis point cut that could be on the table. It's also perhaps the end of quantitative tightening altogether. And this is where that discount window is so crucial. $153 billion. If you look at the Fed's balance sheet, which has slowly been coming down, you essentially see a spike back up in those assets, which tells you at the end of the day, in some form, this is quantitative easing to some extent.
All right, Kriti, thanks very much. Kriti Gupta there talking to us about what to expect from the Fed, what we've seen from the Fed. It's been a roller coaster week, not just for U.S. banks, but of course for Credit Suisse. The Swiss bank and UBS are said to be resisting the idea, as usual, of a forced combination that some in the industry say would boost investor confidence. Bloomberg has learned UBS is reluctant to take on the risks related to its smaller rival. That's been the case for some time now. Joining us from Zurich is Bloomberg's Oliver Crook. So, Oliver, where do things stand this morning?
Right, Matt, let's pick up on that UBS and Credit Suisse story in a little bit. First, let's just deal with this morning and pick up with some of the themes that you've talked about. You talk about the three J's. Let's not forget the fourth J, Thomas Jordan, who injected 50 billion francs to stem the bleed here in Credit Suisse. The question is also, is it enough? And that is something that we're going to have to see play out over the next couple of days. How will clients react to what has happened over the last few days? How will counterparties react? And all of this will dictate, and of course, a market that has been basically the autocrat in this. It is a market-driven story. It was not a lot of news that precipitated this, that brought the stock down and that forced the S&P into the market. And the question going forward is it enough for Credit Suisse to remain as it is today?
Right. And so what does happen from here to Credit Suisse? We've talked about the possibility. Your thoughts then, Ollie, about some kind of tie-up with UBS, even as the two businesses themselves push back against that?
That's right. I mean, it's important to say what Credit Suisse has said. They're continuing to stick by their turnaround plan. They're hoping, I think, that the liquidity here will be adequate in order for them to get the amount of time and breathing room to push this forward. But a lot of analysts are skeptical of this. And so JP Morgan out again saying that the most likely scenario is a takeover from this bank here, UBS, to this one here, Credit Suisse. And this looms large today over this. But when you start scrutinizing this, in addition to the reporting that we've had, there are some issues that start to arise. For UBS, their priority is expansion into the United States. Credit Suisse does not bring them a lot on that. And then there's also the question of overlap. The overlap of clients, this brings up all kinds of antitrust issues. Also, if there is a takeover, does the Swiss government want that? That could cost jobs. And then bring to that also the risk profile that Matt just mentioned. You know, does UBS have the same risk appetite for some of the clients? The answer also, according to our reporting, is no. And then the last question for me is, what has the impact of the last couple of days been in terms of client flows from Credit Suisse to UBS? That is a question that I think we'll see answered over the next few weeks.
Absolutely critical question as well. Oliver, thanks very much. Bloomberg's Oliver Crook reporting live from Zurich on the turmoil at Credit Suisse. Now, let's get more on the headlines that just crossed the Bloomberg terminal. China is going to cut the reserve requirement ratio, the so-called triple R, by 25 basis points. That is stimulative, of course, of the Chinese economy. So why are they doing it, and what will the result be? Joining us to talk about this is John Liu. He's Bloomberg's executive editor in Greater China for Greater China in Beijing. So, John, tell us what we know.
Well, what we know is that reserve ratio requirement is going to be cut from next week, March 27th. It's being cut by 25 basis points. As you said, that will be stimulative for the economy. It will release more liquidity into the system from those commercial bank reserves that are currently held at the central bank. This is happening after the economic data that we got for the month of January and February It showed a recovery, but it was weaker than many had hoped for. And we've had some more high-frequency data for the first couple of weeks of March, showing things like car sales and home sales have not done as well as people had hoped they might. And so it does look like that the authorities are taking steps now to try and make sure that there's enough liquidity to keep that rebound going after the reopening post-COVID-0.
John, it's interesting to see policy moving in the other direction in China then, compared to other parts of the world. Certainly many Western economies still hiking at this point. This is going to be something that has an impact on Chinese assets.
It should. I mean, throughout the sort of tumult that we've seen in the last week, Chinese assets have stood out for being relatively stable. I think that the country here, the economy here being on a different part of the cycle is part of that. It being relatively insulated from global financial markets is another part. I think signs that the government is ready and willing to do more to propel growth, I think that will be taken positively by the markets here.
John, thanks so much. Bloomberg's John Liu giving us the latest there on that surprise news from Beijing. Coming up on Credit Suisse, Joost Beaumont joins us, ABN Amro, head of bank research. What does he think the future looks like for the Swiss lender? We will also talk to Beata Manthey, Citi's head of European equity strategy. How much will the rest of the banking sector recover? How much does the rest of the European equity market recover from recent selling? Plus, the end of an economic era. Today's big take story looks at the chaotic week that was and where we are headed next. Look for that online or on the Bloomberg terminal. This is Bloomberg.
In Europe, we have strong supervision, we have strong capital, and we have solid liquidity positions. And as the Vice President said, exposures are not concentrated. And based on the work that has been conducted by the SSM, we don't have similar occurrence as the one that occurred in California, for instance.
That was the ECB President Francine Lacqua talking about the strength of the European banking system. The focus for Europe has been very much on Credit Suisse this week. Let's talk about the fate of that bank and others. Joost Beaumont joins us, head of bank research at ABN Amro. Joost, very nice to have you with us. So there's the Credit Suisse story to talk about. There's the latest efforts in the United States to shore up the banking sector there. Let me start with Credit Suisse. CDS, of course, we saw a real blowout in the cost of insuring against default on Credit Suisse debt during the course of this week. Some slight normalisation, although that would be going too far on that number, but not really very much. And so still an elevated level of concern about this business, Joost. Where does this end for Credit Suisse? What do you think happens from here for this business?
Yeah, that's, of course, the $1 million question. And indeed, as you said, some calm has been restored for now. But it is, of course, the most beleaguered bank in Europe at the moment. But I think that the regulators were right to step in, to say the bank is well capitalized. It has a lot of cash at hand. They can get liquidity at the central bank. So for now, it should just be able to operate on a standalone basis. Of course, it's all about investor confidence, which is not that strong, of course, to put it mildly. And I think what triggered this week's actually events was the announcement in the annual report about the weaknesses in the finance and control, and then the Saudi National Bank saying we don't want to put more money in, but if you listen to that carefully, basically, they mentioned that they are not able to do so, that it's more like from a regulatory perspective. So it has nothing to do with their faith in the bank. But yeah, if confidence
yes, we certainly listened to detail. Yeah, we listened to a lot of detail there from the Saudi National Bank. Talking to our colleague, in fact, Yusuf Gamal Al-Din over in Saudi Arabia. From one SNB to another, though, they certainly have a lot of support from the Swiss National Bank, from that SNB, and from FINMA, the Swiss regulator. Both of them have looked at the capital levels of this business and felt able to step in. That's a show of confidence. Does that work to convince the markets that this business then has an independent future? Or do you see a tie-up with UBS as likely?
I think with your reporter earlier in the news, maybe a tie with UBS will be quite difficult. Of course, it needs approval of I guess, Swiss government. Maybe you don't want too big of a bank, so it might hurt also competition in the country. So that scenario might be unlikely. And but still, there's a long road ahead for Credit Suisse. They are, of course, in this strategic review. They're still loss-making, and only in 2024 they expect to be profitable again. So that's still a long and I guess a bumpy road to get to. And the question is, will it indeed do that alone, or will it in the end be maybe taken over by someone else? But I want to stress that if you look at the balance sheet itself of the bank, they have a lot of loans which are collateralized. So basically the quality of their assets is not an issue. It's more the confidence in executing the strategic review, etc.
Joost, I was wondering about just that. You know, this past week, a lot of Americans have been shocked that banks fell below book value in terms of their price. I wasn't as surprised, having covered European banks for the last 6 or 7 years. That was pretty normal. However, I have never seen a bank fall to this level. Credit Suisse was trading at just 0.15 times book value. What does that mean about maybe the faith that you have in its book value?
It shows that investors do not have a lot of faith in it, I think what is the key is confidence here. And if you get in an annual report a statement that maybe your controls are weak, then investors might start to doubt whether the numbers in the whole annual report, how you need to read these. So. The only thing Credit Suisse can do is step up its efforts to turn around its business. Of course, it can benefit heavily from the rise in interest rates, from net interest margins that are positive, and slowly it should get out of the woods. But like I said, it's a very long and winding road.
I wonder about, here in the U.S., it seemed that regulators were quite keen to rescue depositors. They don't want to use the word bailout, and they seem to want to zero out shareholders and some bondholders as well. Is that the case, you think, with Credit Suisse as well? If there comes a time when they really need to be bailed out beyond even the 50 billion franc rescue we've seen so far, are they going to want to penalize shareholders, which is one reason that people should keep their hands off of this equity?
I guess so. If you go to a scenario where they will be sold, if they're sold, of course, then you get some price for that. So that's a different case. But again, indeed, as an equity investor, you of course lose money if things go wrong. But I want to stress again, they have like 100 billion Swiss francs in loss-absorbing capital. They have a balance sheet of 500 billion and risk-weighted assets of around 250 billion. So in a way, they can withstand absorb quite a lot of losses before really getting into trouble. But the market is not focused, I think, on these numbers at the moment.
Joost, would you expect the rest of the European banking sector to bounce back from here, just briefly?
Yeah, bounce back is maybe a big expectation. I think what it all shows is also that the sharp rise in interest rates in the US and also in Europe is just leaving its mark on the economies, and so there might be quite some headwinds ahead of us. So, but the most positive issue is that the bank's net interest margins are very positive, so they could also withstand quite some loan losses in that respect.
Okay. Joost, thank you very much. Thanks for your time. Joost Beaumont of ABN Amro. Great to get your thoughts on the banking sector. We'll broaden our conversation. Beata Manthey joins us, Citi's head of European equity strategy. European stocks rallied so much at the start of this year. Some of that has been unwound now. Where do we head next? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. A tumultuous week draws to an end. The market welcomes a $30 billion rescue deal for First Republic Bank, but Bill Ackman isn't impressed with the move. The ECB delivered a rate hike. Now all eyes will be on the Fed's next meeting next week, with traders debating whether the central bank will follow suit. Meanwhile, in Switzerland, there are rumblings of a combination of Credit Suisse and UBS. Our reporting suggests both banks are pushing back. I'm Anna Edwards in London with Matt Miller in New York. And Matt, really interesting to see that news around First Republic boosting sentiment yesterday on Wall Street, but then actually not helping the individual share price after hours. US futures not looking all that convincing from here.
No, and by the way, this is a pattern that we've seen throughout the last week and a half or so of banking crises. You get these rescues that immediately make investors feel better, and then, you know, the air kind of gets let out as the trade goes on. Let's take a look, though, first at what's going on in China, because just about 30 minutes ago, we saw a cut to the reserve requirement ratio, the so-called RRR. I've got a chart here of the offshore yuan, and you can see that the U.S. dollar had already been very weak against the Chinese currency. This is in London time, right around 9 o'clock, just thereafter London time, 5 a.m. here in the U.S. We saw that headline come across the terminal that they were cutting the RRR by 25 basis points. Then you saw a little bit more of a weakening of the dollar, a strengthening of the yuan, but it still hasn't come back to the levels we saw earlier this morning. Let's take a look at what's going on in terms of the U.S. markets. Anna, you mentioned that S&P futures aren't terribly convincing. They're only up about 0.1%, but we had a pretty great rally in the cash trade yesterday that pushed us all the way back up to, I think, 39.50, 39.60, so just under the 4,000 level on the cash trade, almost erasing the losses that we've seen this week. The U.S. 10-year yield right now is coming down about 3.5 basis points at 3.54. Of course, last week we were up over 4% across the curve, and that has been really the most dramatic volatility, or where we've seen the most dramatic volatility in yields. Gold, I just want to point out that we've seen not so much flows into the dollar as a safe haven. I mean, the Bloomberg Dollar Index is still trading, I think, under 1250, and the record last year was 1353. You have seen investors flock to gold, right now trading at 1932 a troy ounce. And for whatever reason, you've also seen investors, obviously a much smaller extent, it's a much smaller market here, but flock into Bitcoin. It's trading at over 26,000. Now, I had hypothesized last week that one of the issues you see is that when investors pull Bitcoin off of centralized exchanges, those exchanges are forced to turn their treasuries or any other dollar assets into the cryptocurrency, and that's why you see the price drive up. But in the crypto community, there's a lot of talk about distrust in fiat currencies, and hence investors going to the original crypto. Take that with whatever grain of salt you will. In terms of the pre-market movers this morning, First Republic obviously is one of the shares that we're watching very closely. Those shares right now down 6.7% amid concern that it's not quite out of the woods yet, even after the efforts that we've seen from the big Wall Street banks to restore confidence. Of course, JP Morgan led a group of banks to deposit $30 billion into First Republic for at least 120 days. U.S. Steel is a stock that's up in the pre-market almost 5% after that company's earnings per share forecast blew away the Wall Street estimate. The company now expects EPS of at least 58 cents, and the estimate was only for 18 cents. So that's pretty incredible for X. And then NVIDIA also gaining just a little over 1% right now, but those shares were upgraded to overweight at Morgan Stanley, which writes, the development of generational AI is too much of a mega trend to get distracted by tactical concerns. Anna, what do you see in Europe?
Yeah, we see a bit of catch-up here in Europe. European equity markets then going higher. Matt, reference to that really strong cash session that you talked about on Wall Street yesterday. Some of that was after our close, so we have a little bit more to factor in there. I also wonder how much stimulation of the Chinese economy is going to have a kickback into the European story. We can talk about that with our guest in just a moment, and what that will do to energy stocks and energy prices. All of that will be interesting to think about. If we are seeing the Chinese economy looking at more stimulus, that is a really interesting thing to think about. But for the moment, stocks Europe 600 up by 0.8%, and energy stocks are gaining, despite the fact month to date we've actually seen a real drop in oil prices, down by 10%. We see them gaining today as a result of the strength in various risk assets, and so energy names also go higher, up by 2.9%. This is the banking sector breathing. It's not really a sigh of relief, is it? But it's certainly not dropping right now, as we've seen a bit of a distance being put between the banking sector perhaps and what's going on at Credit Suisse, and even some reprieve yesterday for Credit Suisse, although that didn't seem to last too long. We are down by 4%. It's not 10, it's not 20, but we're down by 4% today, back below 2 on the Credit Suisse share price. So we'll certainly watch that with interest. It actually started the day, Matt, in positive territory, but has since retreated.
All right, let's talk about the effects that stock and the entire banking industry has had on European stocks with Beata Manthey. She is Citi head of European equity strategy. And Beata, unlike what we've seen here in the U.S., the S&P looks like it's going to end the week 100 points up on the week. The stock 600 is still down on the week and off about 20 points over the last 2 weeks. How hard is it for European stocks to recover from this loss of confidence in the banking sector?
Good morning, guys, and thank you for having me. I think we need to put the current events in the perspective of the bigger sell-off. So remember, European equities have had an incredible ride. So Stoxx 50 has been up until last week by over 30%, European banks up by 50%. So even without the latest events, we always thought that the market was ready to take some profits. And of course, we've entered all this turbulence and volatility with really the highest net longs positions, the most bullish positioning that we've seen in the past few years on European banks. So no wonder that European banks have responded in such a strong fashion to the downside. Now, going forward, of course, what we've learned through this week is that there is a transmission mechanism of tighter monetary policy. It's non-linear, it's delayed, but tighter monetary policy breaks things, as we found out in a painful way. Some parts of the market are more painful than the others. So I think the investors will try to figure out what that means for the future. And I think the most obvious focus is going to be on increased risks to recession and increased risks to the downside of the EPS of fundamentals.
Well, and you've got central banks working at cross purposes in that respect, don't you, Beata? Because as the Swiss National Bank is handing out, 50 billion francs, you've got the ECB tightening again by 50 basis points. What kind of effect does that have?
Well, it has definitely returned some confidence to the market, right? And the fact that the other banks around the world are joining this week is comforting. But what we've seen from the ECB yesterday is, of course, that perhaps conventional monetary policy, at least here in Europe, and we think that in the US next week, the tightening cycle will continue. The Fed will hike as well as the ECB did yesterday. But there is a big question mark about the non-conventional monetary policy. The latest central bank's actions, SNB and the Fed, tells us that we are starting a really easing cycle on the non-conventional. So that should provide some support to the market and to the economy.
OK, so maybe that's what we should focus on, Beata, when we see that the Chinese central bank, the PBOC, is cutting its RRR. I was taken by this because, of course, we're seeing central banks in the West still hiking. If we do see that from the Fed, maybe we get a pause, a wide range of expectations. But certainly in Europe, we're still seeing hikes. That's what we saw from the ECB. And the concern remains on inflation. What does it mean for what's the European read across, I suppose, from this cut in the RRR, from this stimulus of the Chinese economy? What does that mean for Europe?
So when you look at it from the Chinese perspective, of course, the Chinese authorities are trying to boost the economy, and European equity market is the biggest proxy of playing the upside in the Chinese equity market. So we have these baskets of developed market stocks with big exposure into the Chinese market. And after the reopening of China back in October, November, these stocks in Europe have been boosted the most out of all the other regional proxies for playing the reopening. So definitely that could provide to some parts of the European market, that could provide some boost.
Yes, and is that it's good for European growth? Is it bad for European inflation? Does it, push energy prices higher and the like, Beata? Is that a concern for you?
That's, of course, everything is circular. If energy goes higher, that means inflation will stay longer, and that means that the central banks, like the ECB, will have to stay the course. And let's not forget about wage pressures and pressures on the core inflation. For these reasons, our Citi economists expect the central banks to stay the course, at least on the conventional monetary policy tightening. But of course, it will be very data dependent.
Right, staying the course on traditional monetary tightening, doing other things with other hands. Beata, thank you very much. Beata Manthey, thank you so much for joining us of Citi. Coming up on the programme, Credit Suisse's bond buyback plan. More on how the bank is looking to counter a collapse in market confidence. That's next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the OECD chief economist, Álvaro Pereira. That is at 8:30 a.m. New York time. This is Bloomberg.
Overall, the European banking sector remains strongly capitalised and it remains very liquid. And we have not seen the kind of deposit flights that is causing problems in the US. We've seen some shift from non-interest-bearing deposits to interest-bearing deposits, but typically within the banking system. So that, reduces your net interest margin a little bit, but it doesn't cause a liquidity issue.
That was NatWest Group Chairman Howard Davies speaking to Bloomberg earlier. And Credit Suisse is looking to counter a collapse in market confidence. The bank is poised to save about $70 million with its plan to buy back debt at a discount. Joining us to talk more about this, Irene Garcia Perez, Bloomberg distressed debt reporter. Irene, how did Credit Suisse bondholders react to the announcement yesterday of the debt buyback, and probably more than the 70 million, they were focused on the 50 billion francs in liquidity from the central government?
So we saw a mixed reaction yesterday from the bondholders that were included in the buyback, which are bonds that are ring-fenced in the case of a bail-in, an intervention of the bank. Those were trading up yesterday, but we also saw the so-called bail-in securities, which would be written off or converted into equity if the bank was intervened by the regulator. Those are trading at distressed levels, which shows a bit where the investor mood is these days.
Yeah, so are we seeing different reactions then on different bonds from what you're saying there, Irene?
Yeah, definitely. And it's interesting because Credit Suisse does have a capital cushion and also an additional tier 1 bond cushion that would be, those would be the first ones to be written off. But still, we are seeing an important reaction, a negative reaction from these bail-in bonds.
Okay, interesting stuff. Thank you very much, Bloomberg's Irene Garcia Perez. And be sure to check out Bloomberg's distressed debt newsletter, The Brink. That is published twice a week on Tuesdays and on Fridays, so it seems we're due another one. Right, joining us now, Paul Davies, a Bloomberg opinion columnist, of course, covering banking and finance. He's been writing extensively on Credit Suisse and the wider, so much news flow from the financial services sector. Let's start on Credit Suisse, but then I want to get your comments on what we've seen stateside as well. A lot of talk about whether we see a UBS Credit Suisse combination here. Does that make sense to you? I mean, the participants in that seem to be pushing back against this idea.
Yeah, I mean, absolutely. I don't think either of them really wants to be involved in a merger to clear this up. I mean, to be clear, that would really be a last-ditch solution. Things would have to get significantly worse from here for that to be something that the Swiss government and regulators wanted to make happen. But I mean, look, it would not be ideal. There's a lot of overlap between the businesses. You know, the Swiss bank of Credit Suisse would almost certainly have to be spun off in some way, so you didn't have one bank completely dominating the local market. And then even with the sort of the prize asset, which would be the international wealth operations, and particularly in Asia, there would be a lot of overlap. And it's just kind of, it's very natural that when wealth businesses like that merge, you know, clients sort of look at having exposure that was to two banks, now going to one bank, and will start to move some of their own assets again as well to get their own diversification. So it's sort of, it would be a costly and complicated and difficult thing to do, even if you really wanted to do it.
Right, OK, so that's Credit Suisse, and no doubt that we'll say a lot more about that. I just want to get your thoughts also on First Republic, because this seems like I mean, do you call this innovation or a risk too far, coming through from Janet Yellen? On the one hand, maybe innovative, get the sector together, say, look, this is something that's weighing on you all, you guys need to sort it out, all of you club together, put some money in, and that's what they've done. Or, like Bill Ackman, you say, this is really dangerous, this is spreading the risk from one bank into the rest of the sector.
I mean, in terms of the risk that's being spread to the rest of the sector, it's, you know, for the large banks involved in this, it would be a rounding error. It's kind of, I don't think that is something to worry about. I think what's really interesting here is this is a signal that there is, I mean, while there is, like, plenty of liquidity in the system among the banks, it's just not in the right places. We've got a kind of a distribution issue, and it's some of the smaller banks are seeing, you know, a bit of deposit flight or worries about further deposit flight coming. And that money either goes into treasuries or to money market funds and back to the Fed that way, or it goes to larger banks in the banking system. And either way, the Fed or the larger banks can sort of move it back to where it needs to be. You know, probably temporarily. I mean, there'll need to be a longer-term solution here, but, you know, for now, it's just a kind of everybody's getting together to shift the liquidity back around to where it came from, essentially.
Paul, I mentioned earlier that it seems the SNB and the ECB were working at cross purposes this week with, you know, on the one hand, a 50 billion franc rescue package, and on the other hand, raising rates by 50 basis points. But really, both of those moves seem comforting to me, right? The SNB stands ready as the lender of last resort. That's its job. And the ECB doesn't feel that this crisis is so distressing that it can't continue to fight inflation. What's your take on that, and how do you think the Fed's going to react?
Well, I think it's, I mean, you've got a different set of markets here, right? I mean, there is, you know, not any real signs of the problems that we've seen in the US coming across to the European market so far. I don't think we've seen, you know, any signs of deposits running from smaller banks to larger banks or anything like this. I mean, in terms of the balance of policy, I mean, it's a really interesting question right now, and it's really interesting what the Fed will do next. And I guess one of the ways in which I think about it is you never quite know when the effects of all the interest rates hikes that you've made will come through, and it seems to take a lot of time. But then what we're seeing now, I think, is something a bit like they've been pulling on an elastic band, and the movement in liquidity and the rise in kind of funding costs that we're seeing suddenly hitting banks might well lead to a sudden kind of tightening of credit conditions, you know, less lending, and that's like, you know, suddenly all of the interest rate hikes we've already seen are now kind of catching up with the system, and we'll see a lot of that kind of, you know, tightening of financial conditions coming through all at once through the banking sector.
Are you expecting this crisis to get worse before it gets better? I mean, especially in the U.S., Paul, a lot of people are saying there are more bank runs that could happen. We could see more shut down, but there are thousands of banks here, and we have, in terms of the big banks, what looks like a very well-capitalized, very safe financial system.
I mean, we've got this issue in the US where they did sort of manage to create this sort of two-tier banking system with, you know, all the banks that have more than $250 billion worth of assets are managed as systemically important, or regulated rather as systemically important, and those below, even though some of them could have been regulated and supervised much more tightly, they haven't been. So, and this is kind of one of the things that's causing tension within the system, I think.
Paul, thank you very much. Really good to get your thoughts this morning. Paul Davies of Bloomberg Opinion joining us on set here in London. Coming up later today, Bob Diamond, the CEO of Atlas Merchant Capital, formerly of Barclays fame, of course. That's at 4:30 p.m. in New York, 8:30 p.m. in London. So certainly interesting to get his thoughts on what we're seeing in banking right now. This is Bloomberg.